Hello everyone. Today, our group will present completing the audits. But first, let me introduce our group members. Emadius Buja, Frankie Nell, Nur Akila, and Perry Ben. Introduction. Completing the audits. The completion stage is most critical part in auditing, whereby the auditor has to review the evidence obtained during the audit together with final version of financial statement with objective of performing audit opinions. And now we look at the objective of completing the audits. First one, compliance with auditing standard and Company Act 1965. Second, to analytical review on overall performance of financial statement, to going concern status, to post-balance sheet event, contingency and commitments, opening balance and comparative figures, to audit of accounting estimate, to management representation, to related party transaction, and effect of completing issue on audit report. In completing the audit, there is certain procedure need to be followed. Let us see step by step. First one, compliance with accounting standards and Company Act 1965, whereby the auditor should consider whether the information presented and the policy adopted are in accordance with Company Act 1965 and accounting standard. Company Act 1965 requires company table financial statement annually at AGM and requires account to be kept. Besides that, there is certain financial reporting standards such as presentation of financial standard, event after balance sheet date, related party disclosure, provision, contingent liabilities, and contingent assets. Second procedure is analytical procedure, whereby AI 520 states the auditor should apply analytical procedure at or near the end of the audit when performing overall conclusion as to whether the financial statements are as a whole are consistent with auditor knowledge, with the purpose to confirm the conclusion made during the audit of individual account balances. Analytical review process. First one, comparison the whole result of current year against information for prior period. Second, consider relationship between actual versus expectation, financial versus non-financial information. Third, the reliability of information used to perform analytical review procedure. Fourth, perform final assessment of the reasonableness of company's accounting estimates. Fifth, the accounting estimates are consistent with other audit evidence obtained. For example, in substantive test, auditor conclude that account receivable is fairly stated, and also in performing analytical procedure on account receivable, the conclusion made is still the same. The conclusion made need to be reconfirmed, and it can be a basis for auditor's opinion. The third procedure, going concern. AI 570 requires the auditor to assess the risk of going concern problems at the beginning stage and again during the final reviews. There is going concern assumption. First one, an entity is assumed to be able to continue as a going concern for a foreseeable future period of a time, at least 12 months beyond the year-ended date. Second, accordingly, assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of business. There is a auditor responsibility. First one, consider appropriateness of management use of the going concern assumption in preparation of financial statement. Second, be alert whenever there is any material uncertainty about entity's ability to continue as going concern that should be disclosed in the financial statement. There is an indicator that the going concern may be in doubt, such as operating indications, financial indication, and other indicators. Operating indications is loss of major market, franchise or principal suppliers, shortage of important suppliers, loss of management personnel. Meanwhile, financial indication are net liabilities or net current liabilities, adverse key financial ratios, substantial operating losses, inability to pay creditors as and when due fall, change from credit to cash on delivery transaction with suppliers, inability to obtain financing, arrears or discontinuance of dividends, difficulty to comply with the terms of loan agreements, or unable to service interest and principal. Meanwhile, other indicators are pending legal proceeding against the entity. There is implication on the auditor's report where there is doubt about going concern assumption. The auditor may issue one of 5 possible audit opinions such as qualified, adverse, and disclaimer. Second, the audit conclusion and audit report by professional judgment. First one, once appropriate evidence have been accumulated, auditor should decide whether the question about going concern has been satisfactorily resolved and consider the appropriate audit report. Procedure number 4 is post-balance sheet event, contingencies and commitments. But first, let us see post-balance sheet event. Under AI 160, consider the effect of subsequent event on financial statement on the auditor's report. The subsequent event is used to refer event and fact. Financial reporting standard 110 event after balance sheet are those events for favorable and unfavorable that occurs between balance sheet date and when the financial statements are authorized for issue. And now let us move to post-balance sheet important segment, which is subsequent event time dimension. Under period 1, auditor have a responsibility to perform procedure to discover and evaluate all subsequent event. besides make necessary adjustment to disclose in financial statement. Meanwhile, on period 2, auditors do not have any responsibility to perform audit procedure. Management are responsible to inform auditor of fact may affect the financial statement. Period 3, however, auditors have no responsibility to perform audit procedure. Audit procedure meanwhile, reviewing and testing the process used by management, which is evaluate the data and consider the assumption used. For example, testing the calculation and compare the estimate of current period to last period. Besides that, review subsequent event may provide audit evidence regarding the accounting estimate made by management. Aside from post-balance sheet events, there is contingency, but we focus on contingent liabilities. Contingency defined by potential future obligation to an outside party for an unknown amount resulting from activities that already taken place. Accounting treatment according to MFRS 137, whereby provide a provision is recognized as liability and balance sheet with this contingent liability is not recognized as such, indicate that contingent liability is not recognized as liability because its existence will be confirmed only by the occurrence or non-occurrence of future uncertain events. Audit procedure for contingent liabilities. First, read the minute of meeting and inquiries of management and lawyer. Second, review contracts, loan agreement, lease and correspondence. Third, review income tax liabilities and tax return. Fourth, inspect other of documents for possible guarantees. Next, look at commitments. Before we move further to commitments, it is okay for us to know what is commitment. It is defined an agreement to commit the entity to a set of fixed conditions in the future, regardless what happens to profit or the company economy as a whole. Audit procedure for the commitments. First, inquiry from the management such as ask commitments and obtain letters of representation. Second, documentation by reading minutes, directors, committee meetings, or general meetings. And now look at procedure number 5, whereby opening balances and comparative figures. Opening balances are referring to those account balances which exist at the beginning of the period, or better known as closing balance of last period. Under opening balances, the auditor duties should obtain sufficient evidence. Besides, ensure the opening balances correctly brought forward from previous period or closing balance. Thirdly, appropriate accounting policies are consistent. Moving on to comparative figures. AI 710. Auditors should determine whether the comparative comply in all material respects with the financial reporting framework relevant to financial statement being audited. FRS 101, whereby comparative information shall be disclosed in respect of previous period for all amount. Procedure number 6, audit of accounting estimates. Accounting estimate means allowance to reduce inventory and receivable to the estimated values, depreciation or amortizations, accrued revenue, defer tax provision for loss from lawsuit, and provisions to meet warranty claim. Audit procedures are by reviewing and testing the process used by management, such as evaluate the data and consider for assumption made, for example, estimating income receivable, review aging and considering the accounting policies for doubtful debt, specific provision or general by testing the calculation, compare the estimate of current period to last period, review subsequent event, may provide audit evidence. Procedures number 7. Management representation letter. Management representation letter, a letter from management to confirm the auditor that all information has been properly disclosed in the financial statement and to be dated on the same day the financial statements are approved. Important purpose of management letter are acknowledgement by management its responsibility for the financial statement, representation by management as audit evidence, and to confirm the oral representation. The last procedure is related parties transaction. ISA 550 deal with auditor's responsibility regarding related party relationship and transaction when performing an audit of financial statements. The information has been to be obtained from client at the completion of audit stage to ensure appropriate disclosure in the financial statements. Audit procedure whereby reviewing last year working paper, review minutes, review corporate structure, and discuss with management, confirm with related parties, discuss with management, and inspect documentary evidence. Thank you for watching and thank you for your time.